All right, let's dive into a massive shift in Indian taxation. Today, we're unpacking Chapter 8 of the new Income Tax Act 2025. Specifically, we're going to summarize sections 122 to 154, which deal with deductions to be made in computing total income. Whether you're a chartered accountant, a tax professional, a business owner, or studying for your exams, getting a solid grip on these new provisions is absolutely essential. So let's get right into it. Imagine this scenario for a second. You've carefully planned out all your investments, you've maximized your tax savings instruments, but you missed the return filing deadline by just one single day. Under the new 2025 Act, is that tiny delay going to cost you your entire deduction claim? It's a really high-stakes question, and the rules have definitely tightened up. We'll break down exactly how that works in just a moment. Here is a quick look at what we're covering today. An introduction to the new chapter, key legal provisions, a practical taxation example, compliance updates, some common practical issues, and we'll wrap up with a summary of the key takeaways. Section 1. Introduction to Chapter 8, the shift from 1961 to 2025. For over 6 decades, tax professionals have had Chapter 6A of the 1961 Act practically memorized, right? Well, with the rollout of the Income Tax Act 2025, it's time to update our mental models. Chapter VVA is the brand new statutory framework governing deductions from total income. Functionally, think of it as the modern equivalent of Chapter VVA. The main goal here is to give us a streamlined, simplified tax code with all those provisions consolidated. The language is much clearer now, but the core intent, encouraging savings and specific business activities, remains perfectly intact. Section 2. Key legal provisions explained. Core conditions and limits. Let's break down these legal provisions and do some rapid mapping. This is how the old, familiar sections translate into the new era. Everyone's favorite, Section 80C, which governed life insurance, provident funds, and other specified savings, is now Section 123, and it's read alongside Schedule XV. Similarly, the deduction for additional employee costs that we used to know as Section 80JJAA, that's now mapped to Section 146 of the 2025 Act. It's essentially the exact same house, just with a brand new address. Now, what's really fascinating here is the continuity. The aggregate deduction limit for these specified savings instruments under the new Section 123 remains steady at $150,000. But when you were doing your statutory compliances and using the digital systems, you'll notice a subtle visual shift. The old RS abbreviation is officially gone, replaced entirely by the modern rupee symbol. But here is the absolute kicker, Section 122, subsection 5. Circling back to our earlier question, if you file late, you forfeit your Part C deductions completely. This continues the strict legislative policy we saw previously in Section 80AC. Timely compliance isn't just a best practice anymore. It is a rigid, mandatory legal precondition to claim those deductions. No exceptions. To put your mind at ease, though, the fundamental caps haven't just vanished into thin air. Under the old Section 80A, your deductions couldn't exceed your gross total income. Under the new regime, Section 122 explicitly enforces the exact same ceiling. You still cannot use these deductions to generate a loss. Section 3. Practical taxation example. Transitioning profit-linked deductions. Let's put this into perspective with a real-world scenario. How do you handle a business right in the middle of a multi-year profit-linked deduction? The official FAQs actually outline this perfectly. Imagine a business claiming a deduction under the old Section 80-IA. In the first phase, their 10-year eligibility window kicked off under the 1961 Act. Then, in Phase 2, on April 1, 2026, the transition hits. Those remaining years, they are completely grandfathered in and protected by the 2025 Act's transitional provisions. But here is where it gets a little tricky. In Step 3, the computation itself changes. While your right to claim that deduction flows directly from the old law, the actual quantum, the amount of eligible profit, is calculated entirely under the new computation mechanisms of the 2025 Act. So, if your business profit under the old rules would have been 8.5 crores, but under the new 2025 rules it calculates to 8 crores, your deduction is strictly capped against that new 8 crore base. Section 4. Compliance and documentation. New digital forms and terminology. Okay, let's talk administration. The Income Tax Rules 2026 have really shaken things up, moving us toward a highly standardized, system-driven approach. You absolutely need to update your vocabulary here. That confusing duality of having an assessment year and a previous year is completely gone. We now just use one single term, tax year. You're going to see this uniformly across all the new compliance forms. There is also a massive emphasis on digital verification, using a chartered accountant's digital signature certificate. And honestly, to save everyone some time, basic taxpayer details are now going to be pre-filled right on the portals. Here is a quick rundown of some essential new forms. Form 5 is replacing the old mechanism for preliminary expenses under the new Section 44. And yes, that requires a CA certification. For the additional employee cost deduction under Section 146, you are now going to file Form 34. And if you're claiming a deduction for foreign inward remittances, like royalties under Sections 151 or 152, you will need Form 38, which has to be certified by a bank manager. Section 5. Common Practical Issues. Pitfalls to avoid in the new regime. So, what are the traps you absolutely need to avoid during this transition? Well, a massive one is mixing up your regimes. Remember Section 123, our new replacement for ADC? If a taxpayer actually opts for the new concessional tax regime under Section 202, that Section 123 deduction is explicitly disallowed. You cannot have both. You really have to choose your lane carefully. Another spot where people get tripped up is with declarations and options made under the old Act. An option that was exercised under the 1961 Act only survives into the 2025 Act if there is a directly mapped corresponding provision in the new law. If the new law doesn't have an equivalent, your old declaration simply lapses. The legal fiction of transition cannot create a right that just doesn't exist in the new statute. And please do not assume the 2025 Act is some kind of magic eraser for past mistakes. The Savings Clause only preserves validly determined claims. If you filed a loss return late under the 1961 Act, which made it ineligible for carry forward, the 2025 Act will not suddenly cure that defect. Your eligibility is permanently frozen by the conditions of the old law. Section 6, Summary of Key Takeaways, the Essentials for Tax Professionals.
All right, we've covered a ton of ground today. Let's lock in those absolute essentials you need to walk away with. Number 1, shift your mental map. Old Chapter 6 EA is now the new Chapter VA. 2, Section 122.5 makes timely return filing a rigid, non-negotiable precondition for these deductions. 3, while your eligibility for older deductions carries over, the actual amount is going to be recalculated based on the 2025 Act's rules. 4, permanently drop assessment year from your vocabulary. It's all about the tax year now. And lastly, standard savings deductions like Section 123 are completely out the window if you opt for the Section 202 concessional tax regime. With all these fundamental shifts happening, you really have to ask yourself, will your current tax strategies survive this transition, or is it time for a complete portfolio overhaul?
Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.